So the institutional investors and other large big-time investors have pulled back their buying of single-family homes lately. It is having an effect on the market, but again, this is only for a short period of time, and they're going to come back with a vengeance as the year goes on. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today is February the 20th. Hope you guys are doing well. This video is brought to you by our friends at Foreclosure.com. So if you want to check out the distressed property listings in your neck of the woods, your backyard, go to GetHousingData.com. That's GetHousingData.com. All the stuff I talk about here, pre-foreclosures, short sales, tax deeds, whatever, you can find that information at gethousingdata.com. All right, let's get into it right now. So interesting enough, and should come as no surprise to anybody when you take a look at what's happening in the marketplace right now. So the housing market's cooled so much that even the deep-pocketed investors are backing off. So basically, the fourth quarter of 2022, we saw investor home purchases plunge to almost 46% compared to the same period a year before. So as mortgage rates rose and home prices declined, this is from a Redfin researcher, basically we just saw a massive pullback in purchases. Now, of course, nobody wants to overbuy and overcommit. And typically, as I always say, the feet on the street, boots in the ground, whatever you want to call it, the investor market always is the first to either sense what's happening in the marketplace and the first to react and change or pivot and do what they need to do. So basically, realize they see it first. Now, if you take a look at across the board here, investors are buying far fewer homes than they were a year ago. You could even take a look at the heat map here. This is an article from Fortune.com. But essentially, the shift in investor home purchases between Q4 2021 and Q4 2022, you can see that the darker color, the dark red or almost burgundy versus the yellow and orange, you can see where up to 50% is where they've pulled back. So you've got certainly stuff on the West Coast, central west part of the U.S. Obviously, the South, you've got Atlanta, looks like Charlotte, something over in the Tennessee area. You got Jacksonville, Orlando, Tampa area, and obviously a little bit Lauderdale, Miami, etc. And other parts, of course, of the U.S. But this is where the majority of the pullback is. The deeper, we'll call it deeper hits with respect to investor purchases slowing down. It's you follow the money. That's how I look at it. Follow the money. You're never going to go wrong with following the money. But you can see the markets that are pulling back. So pandemic boom towns like Vegas and Phoenix already seen sharp corrections. In Vegas, investor home purchases fell 67% in the last quarter, the fourth quarter of last year. And they found that to be the largest decline in the 40 metros they looked at. Phoenix saw a 66.7% decline. Nassau County, which is up, Nassau County is the area around, either could be Long Island or that could be the area around Jacksonville. 63% drop. Atlanta's almost 63% drop. Charlotte is almost 62% drop. The other half, according to the report, included Jacksonville down 57.1%. Nashville down almost 55%, Sacramento 53.5%, Riverside 53%, Orlando almost 52%. So we're seeing big time pullbacks on investor purchases in these markets. It should come as no surprise, right? There's been a shift at what they're buying. Obviously, they're looking for single family homes. Obviously that's dropped quite a bit in the fourth quarter. Investor purchases of condos dropped almost 36%. Multifamily properties dropped 31%. But the biggest drop has been, almost 50% for single-family homes. Now, they're tightening their purse strings with purchases of high-priced and mid-priced homes both declining by 50%. Meanwhile, purchases of low-priced homes dropped 28.6%. So, obviously, investors are going to pull back where it makes sense. Why overpay? Why run up cost profiles when we don't have to? But you can see they didn't pull back too much with the smaller, lower end homes because you can always fix and flip those. You can always rent them out. There's still margin there in that market if you can find them. Obviously, the higher price stuff is going to sit longer and they're not going to purchase. So you got to be aware what's happening in your own marketplace. But it's interesting enough to see that does this have an effect on the marketplace? You bet it does, because what are you going to see? You're going to see less bidding wars. You're going to see less prices being pushed up. It's possible investors will wade back into the market this year, given the mortgage rates have ticked down from their 2022 high, especially if home prices show signs of bottoming. But it's unlikely investors will return with the same vigor they had in 2021. And that could actually be good news for individual buyers. They're saying at Redfin that they may no longer lose bidding wars to investors. So the problem with real estate is if you're the average person, and again, nothing wrong with being an average person. Someone actually commented to me saying, why do I call people average? Well, when I say average, I mean normal retail buyers. Okay, that's what I mean. All right, no insult that we're all average. Okay, you're much more, you're well above average. Okay, anyway, but the point is that the normal home buyer that's looking to live in a home as their primary residence, would be competing against smaller investors looking to fix and flip, make a quick buck, or institutional larger investors, real estate investment trusts, whatever they are. All right. So if less of that's going on, that means more property available for retail normal buyers, all right, who want to live, as opposed to people who are looking to return on their capital. So should be a little better for the average, again, the normal buyer, I guess you could say. But this is the nature of the business, right? So less investors, less artificial pushing up of price points. That becomes the norm. So there you go. So how do I look at this? Well, as I said, it's very obvious when you're in the marketplace here. It's the feet on the street that see it first. So why do I always talk about this? Well, they see the market dynamic changes first. So if you're buying and selling, you're wholesaling, you're fixing and flipping, whatever you're doing, you're going to see what's happening in the marketplace right away, because you're seeing it and you're feeling it with respect to what real estate agents are saying, what buyers are saying, what sellers are saying, and you need to figure out what to do and work with the changes. So obviously the investor markets reduce the purchase price offers. They're not actually asking as much for property. Their bid prices are lower now. Investors also, what we do is it's called normalized inventory. So you know what? If inventory is starting to increase and prices are going down, basically you're going to sell off non-performers. So maybe things were marginal at best on certain properties, on cash flow, etc., or maybe just makes sense to sell. Don't want to put out any more capital. So some of the investors will start to sell off some of their non-performing or poor performing inventory or assets to free up cash and to get rid of them, because they know if they're poor performing now, if the market keeps decreasing or dropping, it's going to get even worse. So you normalize your inventory. Obviously, they've pulled back on the actual activity, pulled back number of transactions and what they're doing. And what people do, or what real investment companies do, is they analyze where the market's headed. They change strategy, and they pivot to get ahead of the next market cycle. That's what's going on right now. As a matter of fact, I attended a mastermind on Friday a couple of days ago, and what's been talked about in the real estate investment world is dominating the downturn, being ready to pivot, figuring out what's going on in the market. And yeah, it can be difficult, and each market or MSA has its own local nuances, but the point is that you got to look to see what's happening, be aware, and look for deals that you can control. Those are wholesale buy and sell type deals, or short sales. That's what they were talking about. But I guess the point here is that for everyday people, normal people who are looking to buy and sell, the investor marketplace always is ahead of the game, and they're quicker to react, and they're already looking at the next cycle, or where this current cycle is going in, or where the next few months are going to be, to pivot and figure out what they're going to do and how they deploy their capital. It's the way it typically runs. Now, by the way, everybody, if you like the information I provide, if you could smash that subscribe button and help my channel grow, I'd really appreciate that. And if you are a subscriber, if you could just verify and resubscribe, because I lose subscribers every day. Seems like if I don't put a few videos out for a couple of days, I lose a ton of subscribers. So that's the way it goes in YouTube world. Now, funny enough, though, this is how things are changing. So my video started off with saying, hey, investors are pulling back, and they are pulling back. However, they're also, I guess you say, cash hoarding for their buying spree. So Blackstone, KKR, among firms gearing up to purchase single-family rentals. Wall Street has amassed a considerable war chest to take advantage of the shifting housing market. So yeah, they're pulling back on what they're buying right now. Why? Because it's going to be a frenzy as time goes on, and we have to be well aware of that. So institutional investors have earmarked up to $110 billion to purchase or build single-family rentals. That's been reported. The estimate comes from Zelman and Associates, which hailed the amount as the most ever accumulated by investors to acquire U.S. homes. Of the 110 billion, 30 billion has already been committed to properties being leased or developed, said one of their investment bankers. So the money is enough for roughly 400,000 homes. Institutional investors already own about 700,000 homes. It's only 3% of the nation's 20 million single-family rentals. According to Roostock, it predicts it will grow to 40% by 2030. So they're at 3% right now of the single-family rentals, and they want to grow the next 7 years to 40% by. That's a 37% growth. That's huge growth. By 2030. The players are gearing up for a home buying spree in the $4.4 trillion single-family rental market. Run the gamut, but include major names like Invitation Homes, Tricon Residential, Blackstone, and KKR, as well as wealth managers and pensions funds such as CalPERS and Invesco. So again, there are certain groups or companies that's what they do, is they buy because that's what their business is all about. Then you've got the funds, the pension funds and stuff that like to diversify their portfolio and have some real estate in some of their portfolio as well. Now, this is very interesting for me because I would love to hook up with some of these groups or people who want to build smaller portfolios and help you guys do that. I'm putting the word out right now. I've talked about it before, but we want to get into that big time. So smaller deals, not smaller deals, but smaller portfolios. Certainly want to work with people who are looking to do that and partner with people. So again, that's what's happening in the marketplace. So as much as currently investors pulling back, they've amassed capital and they're going to deploy it when the market shifts a lot more, and that's going to happen. So obviously they're looking for a better bet than their traditional property holdings. In addition to single-family rentals, they've been drawn to multifamily buildings and industrial assets. Institutions pumped $50 billion into the single-family market rental in the first 2 years of the pandemic, said John Burns Consulting. But the market has shifted in recent months as rising mortgage rates sideline not only individuals but institutions. Because yes, institutional investors do get money from money sources. So clearly, if their money sources are increasing their interest rates, then they're not going to buy as much, or they're going to wait for a cheaper price homes to become available. Single-family rental transaction volume was down 70% year over year through November, which is a pretty significant amount. And again, it just goes with price points are at. So higher price points and higher interest rates are also affecting investors as well too. The housing market is presenting an opportunity for investors. Many individuals want to live in houses, don't want to buy at the moment because prices and mortgage rates have jumped, or they expect to move in the near future. Prices could decline in 2023 as more homes are listed for sale. Investors are also working with builders on build-to-rent communities, allow investors to score deals and builders to ease inventory crunches. So that's something we're looking at as well too. So we do have some opportunities for some build-to-rent or build-to-flip as well. If you'd like more information, you can ping me and we can talk about that. But here is the scoop though, is that, I always mention this, we're talking about what? Interest rates, inventory, price points, whatever. Going back to the basics here, no one speaks about, in these articles that, oh my goodness, when things do shift, there's a whole wave of foreclosures just waiting to get snatched up. So a lot of these investors will be buying at foreclosure auctions where they can probably get, properties at cheaper price points than they would on the open market through wholesaler or retail channels. So again, a lot of this is discussion points, but still ignoring the vast inventory of pre-foreclosure, i.e. shadow inventory that's kicking around behind the scenes. So that will change as the time goes on. All right, guys. So distressed property opportunities, what's going on? Obviously, you can buy stuff at the foreclosure auction. You can get bank owns afterwards, right? Foreclosed on REOs. You can do short sales. You can do short payoffs. You can do subject to the mortgage. It's a little difficult to do that, but you got to learn that. There's going to be homeowner association, condo association foreclosures, a lot more probate in the states we're seeing right now. And as a result of all these foreclosures, not to mention tax deed foreclosures, there's going to be what we call foreclosure surplus or overage, which is another niche market to earn income. So all these are available now and will increase as time goes on. We're open for business. I keep saying that. Connect with us, okay? Buyers, new home construction, we can handle that. Existing MLS properties, investment opportunities, whether you want cash flow, Airbnb, fix and flip, we can get our hands on them. We can do single family, multifamily. I do have access to both of those. Build to rent, build to flip projects. We also have access to financing. We can hook you up with the right financiers, hard money lenders, different rental lenders or fix and flip renters, the whole bit. So we pretty much the full shop here at where I manage and work. and do what I do. So that's the opportunity, everybody. So jump on it now. So again, new foreclosure program going forward. Jump on this as well too. I can tell you that people are interested in doing a lot of stuff as time goes on this year and next year. So get on now before everyone jumps in the bandwagon and you lose your opportunity. If you want to get a hold of me, that's my email. Send me an email, give me your phone information, and we can chat as soon as you're available. All right, guys. Thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. We'll look forward to speaking with you in a couple of days.